The Norris Group would like to thank the following Platinum Partners: the San Diego Creative Real Estate Investors Association, InvestClub, ThinkRealty, Coach Fullerton, Keller Williams Corona, Property Radar, the Apartment Owners Association, MVT Productions, and Realty 411.
Good evening. Oh, this is actually the very first year that we're not live streaming, so I am so much more relaxed. Welcome to the 12th annual I Survive Real Estate event. I am Aaron Norris. Thank you for being here. Some of you are new to the scene. You're like, I don't know why I'm here. Just sit back and relax. We were having a joke. Every time the word says real estate, it says you can just have a sip of wine and you'll have a lovely evening. Sometimes couples bring their significant other and they only come once because they're not diehard real estate fans. Hopefully nobody here is like that. But please have a great time tonight. I Survive Real Estate happens once a year. We come together in one place for one night to discuss the year ahead while benefiting two incredibly awesome charities. We started this event back in 2008 during the recession to celebrate our industry and to raise money to defeat cancer and to help people who have been impacted directly and indirectly, which unfortunately happens to so many of us. So, as we do every year, if you or somebody that you know is struggling or has struggled with cancer, will you please briefly stand up? And that's why we're here. And while you are standing, can we please do the Pledge of Allegiance? Ready? Begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Over the past 3 months, we have together raised over $55,000. Thank you. Yay. Bringing our 12-year total to over $925,000. We are oh so close to that $1 million mark, and we expect it to happen next year, so we hope you'll be all be back. I Survived Real Estate is completely underwritten by the Norris Group, so 100% of what we raise tonight via ticket sales or sponsorships actually do go to the two charities that are benefiting tonight, Make-A-Wish of the Inland Empire and Orange County, and St. Jude Children's Research Hospital. So, if you happen to be sitting at a table and you're given a ticket, don't worry, we're going to be hitting you up. There are ways to participate. You've got Make-A-Wish has left a card on your table, and you can meet them out in the hallway, as well as St. Jude in your program has a house giveaway. They actually have a raffle. All of a sudden, that program, everyone's like, what? How did I miss that? Yes, there's a house raffle for here in California. So aren't you happy you attended? So there's ways that you can participate tonight. Later on, if you're watching this online via Amazon, YouTube, Facebook, or any other of the digital channels, please go to isurviverealestate.com, hit that video tab, and you can see our program, see all of our sponsors, information on our speakers, and ways that you can get involved and donate to the charities. And if you like the show, please do. With that, I would like to ask Amanda Soto with St. Jude Children's Research Hospital to share a little bit about their mission. And while she's making her way up, let's watch a short video.
I really look forward to, playing video games with Zach.
Carson is nice and kind, and he loves video games, and
we both really like video games. So I knew he'd be a friend from the moment I first saw him.
I love him.
It's a button sequence that you have to do. You got to do the left stick up twice, and then press, which one was it?
B and up at the same time.
B and up at the same time.
I call him sometimes when he's in his transplant, and he would, kept to memory when I'd have my amputation.
We always play with each other, and we talk about the good things and encourage each other to do good at our appointments.
And we make jokes.
Yeah. There was this one time when me and Zach were gonna go to the zoo, but I didn't feel good enough to be able to go. So we just played video games after when I was better.
Mm-hmm. Third jump. Good job. Pretty much get together and just play games and have fun and don't really think about the other stuff. I may ask if your appointments went well today or if you were feeling good, but
We focus on our friendship and just make that our main goal, and just don't worry about all the pain and stuff like that.
I don't have to take pain medicine as much, and they help distract me, and it's helped a lot. Cancer has come back a few times. Now it's gone again, so I'm gonna go home soon.
We're gonna, play online and FaceTime each other so we can talk and see each other even from far away.
Uh-oh, wrong button, wrong button. Oh.
You're gonna get defeated.
Oh, man.
I just want to say that St. Jude is a great place, and they've given me my life back.
All the treatments and surgeries and everything else.
I think it's great at no matter what. People will always help us kids at St. Jude.
Good game!
Thank you, Erin. Oh, can you hear me okay? Okay, wonderful. Thank you once again, and I want to thank the Norris Group for having us here, for inviting us once again this year to be a recipient of such generosity. I'm very honored to be here tonight and share the stage with another amazing nonprofit, which is the Make-A-Wish Foundation. It is truly an honor. And first of all, good evening, ladies and gentlemen. I also want to thank you directly. Your presence here is showing lots of support to St. Jude Children's Research Hospital. And thanks to you, families like those of Carson and Zach do not pay a bill for their travel, treatment, housing, or even food. And that all is made possible because of the contributions from individuals such as yourselves and amazing organizations such as the Norris Group. So thanks to your gifts, St. Jude Children's Research Hospital is able to continue the life-saving research that it's done. Ever since the hospital first opened in 1962, the childhood cancer survival rate has gone from 20 to 80% in just over 50 years. I should mention, however, that that statistic only applies within the United States. Unfortunately, throughout the world, that statistic still remains like it was in the 1960s, where it's at 80-20. So that means that 4 out of every 5 children, unfortunately, will not survive. But because of that, St. Jude is saying, you know, we're not doing enough. And thanks to your contributions, St. Jude Research Hospital has made a commitment of $100 million to invest in global programs to help raise the childhood cancer survival rate to 60% by the year 2030. Yes. And again, all that would not be possible without the kind-hearted support of individuals such as yourselves, organizations such as the Norris Group. So our commitment is that no child should die in the dawn of life, as our founder, Donnie Thomas, once said. And once again, I'd like to thank you on behalf of our patient heroes, such as Zach and Carson, and the St. Jude family. Thank you, and have a wonderful evening.
All right. Thank you, Amanda. Next, the brand new CEO, 16 days in, Make-A-Wish of Orange County and the Inland Empire, Gloria Crockett. And while she's coming up to the stage, please watch this great video.
So we're really excited to be here today at the Orange County School of Arts. And their students are actually helping us grant a wish to Kaylin. And her wish was to be a pop star, and so they're going to provide the band and the backup singers and dancers. And so we're really, going to provide her the most amazing experience ever.
Kaylin came premature and something wasn't right. It was like a mommy gut feeling. And then it started with all kinds of issues. Her not being able to keep food down, her throwing up, and then we were in the hospital when she first got her first bloody diaper, and then it was just downhill after that. She ended up being TPN dependent. She went through numerous surgeries trying to figure out what's wrong with her. Nights of her in stomach pain, nights of her crying, saying she just sometimes felt like giving up, her missing out on school activities, family vacations, having no friends, to where her friend that she had was just her friend in the hospital. So being through everything she's been through and still waking up every day with hopes and dreams and goals, it's priceless.
This is probably the most special, most important, best event that I've ever done in my entire career. And I want to do more of them. I think that it's important for all of us to give back and to reach out, because the need is there, and it's so fulfilling, and it's better than any paycheck. It's better than any name on a sign to give an experience like this to someone like Kaylin, who's so deserving.
Thank you everyone from OSHA. Thank you everyone for being my fan, and it means so much to me.
Good evening, everyone, and thank you, Erin, and thank you to the Norris group. These videos we've seen tonight, oh my gosh. These kiddos, are they not absolutely amazing? Because of each and every one of you, you've made an impact in their lives. Their lives have been changed. Their lives have been inspired because of organizations such as St. Jude's and Make-A-Wish, in which you've all come together this evening to make a difference. Can you guys believe that? Almost $925,000. That is absolutely amazing. So as you've heard, my name is Gloria Crockett. I've been with Make-A-Wish for 16 days. And I am excited, I am humbled, I am inspired. I've seen that video 3 times, and I've cried each time. It's amazing what we're able to do. I oversee the offices that cover Orange County, San Bernardino County, and Riverside County. And I'm humbled by the job I get to do every single day. So Kaylin's wish, was that absolutely amazing? To be a rock star? I know, I might want to be a rock star someday, but my gosh, you saw Kaylin's wish gave her the opportunity that allowed her to shine bright after many, many difficult years that were spent in the hospital. For her family, it was a moment to celebrate after years of uncertainty, hospital stays, and doctor's appointments. As we continue to tell stories about that day, we know that this life-changing experience was not only for Kaylin and her family, it was for the students, it was for the backup dancers, it was for the band, it was for the faculty, it was for the advisors, and we know that it had a great impact on the hundreds of individuals that were out in the audience cheering for her as she rocked out that stage and singing. Wishes inspire hope. They spark inspiration. They celebrate joy for those who are involved in creating that wish and making it a reality. We believe that a granted wish is truly transformational. So at Make-A-Wish this year, we have a goal to grant 348 wishes. That is one wish every 25 hours. Wow. Not only do we grant wishes for our chapter, but we help other chapters across the nation, in which there are 60, to help grant wishes in our area. A lot of children want to come in and have wishes granted at Disneyland, or they want to meet celebrities. So we do a lot of that with our partners across the nation as well, actually around the world. Unfortunately, according to the Centers for Disease Control, only about half of the wishes are currently being granted that for eligible kids. And so the children that are served by Make-A-Wish are between the ages of 2.5 and 18 and are currently battling a critical illness. But thanks to all of the support today, you'll help us strive to make that goal of that 348 and continue to allow us to serve those kids that would like a wish to come true. Every kid that is battling a critical illness, we would like them to have the opportunity to live out their most heartfelt wish and make memories that last a lifetime. On behalf of the Wish children and their families, volunteers, supporters, our board of directors, and our staff team, we want to thank each and every one of you, the Norris Group, and all of their friends for making this a reality for Make-A-Wish. We have to say thank you for all of you. We're also excited. On the table, you see that there was a wish that was supported, is being supported by I Survived Real Estate 2019, adopted the wish of Elijah. Elijah wanted to meet his favorite entrepreneur, Jeff Bezos. Is that not a cool wish? My goodness. And I thought, wow, that's pretty powerful. So without friends like you, we would not be able to make the transformational changes that we do. And I cannot wait to continue my journey as the new CEO at Make-A-Wish Orange County and the Inland Empire to create more memories with each and every one of you. So thank you so very much.
Thanks again, sponsors. None of this tonight is possible without your support over the years. After hosting this event for so many years, now in year 12, a lot of faces around the room become family. This is almost like a family reunion. Throws me off every year. We don't have name tags. You're all dressed up. In a different, it blows your mind, but we're so grateful for your continued commitment to come out here. Very briefly, and many of you are already aware, we lost somebody very important to this family this year in Geraldine Berry from Northern California. She was here since the very beginning. She was instrumental in bringing everybody from Northern California down, and she was a very dear friend. And if you didn't know, it's just her legacy lives on by all you Northern California people who continue to come down, and I just really appreciate it. She's always an inspiration, never forgettable, but we will definitely miss that Irish accent running around, her causing problems, something to cherish, but wanted to let you know. All right, now on to the business. I'd like to quickly thank our team, Robin, Vicky, Holly, Donna, Joey, Don, Mike, and Rich, who have been helping throughout the night, running around tonight, making it go smoothly. Thank you. White House Catering and MVT Productions, who make life so much easier and have been here since the beginning. I'd like you to actually leave your cell phones out. Please put them on vibrate so the show isn't interrupted tonight. You can follow along on social media using hashtag ISRE. But tonight, I actually need your help. One of the reasons we didn't want to live stream is because we want you to participate a few times in some online questions. So with your phone out, I can already give you a warning right now. Please don't. I'll tell you how to do it first. All one word, no spaces. Text the Norris Group to the number 22333. I'll give you a second. You can tell that too many people have been watching Game of Thrones. Winter is coming, apparently, in the economy. We want you, to do that, after you put the Norris Group and you text it to 22333, I'd like you to text the one word on how you're feeling about the economy right now. While you are all busy texting, using your phones for a good cause, I would like to invite the man up to the stage who's been in the business next year, when we will hopefully hit 1 million. He'll have been in the business for 40 years. He's a real estate investor, builder, hard money lender. He hosts our weekly award-winning radio show. He loves to yellow line charts, and he does his best to advocate for an industry he loves very much. I get to call him Pops. Bruce Norris.
Thank you. Love you. Thank you, Aaron. This was Aaron's brainchild, by the way. He's done an amazing job with it. In 1981, I attended a seminar I really didn't want to go to, and happened to change my life. A gentleman named Jim Rohn. For whatever reason, I was ready to hear him, and he gave this talk. I went home and wrote goals for the first time in my life, and my life's never been the same. When he passed away, I got the idea of honoring his legacy with an award. And we asked the Rohn people if we could do that, and they agreed. And so every year we hand out something called the RONI Award. And it is reserved for the very best of the best in our industry. The people that have given back to their fellow investor and taught them things that enabled them to better support their family. Tonight we have Jack Fullerton here, who was the first recipient. And Pete Fortunato, all the way from Florida, back from him getting the award last year with John Schaub. Tonight, we get to honor Dykes Boddiford. You're too early. Somebody's given me something to read. I think your family is kind of put some stuff in here, so it's going to be fun for you. Dykes grew up on a farm in rural South Georgia, where he learned the meaning of hard work as he watched his dad and uncles running various agricultural businesses in the area. His pursuits did not include farming, but instead resulted in his grandmother banning him from conducting scientific experiments in the house. His astute grandfather bought him a chemistry lab and helped him set it up in the barn far away from the house. He eventually pursued his love of science and attended Georgia Tech, studying physics and eventually obtaining a graduate degree in computer science. Even today, many of his friends still refer to him as rocket scientist. Dykes met his future wife, Debbie, who's with us tonight as well, at Georgia Tech. But incredibly, it wasn't until years later they would reconnect and get married. They have 2 daughters, Dorsey and Lori. Working as vice president of a prestigious engineering firm, he became involved in Georgia REIA, started learning about and investing in real estate on the side. Debbie still reminds Dykes of one of his first investments, small apartment in a less than desirable area of Atlanta where she would go pregnant to collect rent. When the engineering firm was eventually sold, he moved into real estate full time. Dykes learned about land trust, and as he began investing and got so many questions about trust, he started teaching a small class on the subject. Over time, it would grow to include information on entities, tax strategies, asset protection, which many of us know him for best today. Wanting always to include his family in the business, daughter Dorsey recollects that in order to be allowed to watch cartoons, she had to first compile binders for the upcoming events. She later discovered that her dad had gotten a quote from his printer for binding, and he used that in class as evidence how a couple of children could save you a lot of money. All those funds went toward their IRAs, of course. Dykes would sometimes be a guest on an Atlanta real estate investment talk show, and one day his daughter Lori happened to hear him on the radio. She thought, That was the coolest thing ever. And asked him later in the evening, Daddy, are we rich? And his response was, who's this we? Today, both daughters are real estate investors. His daughter, Dorsey, is a full-time investor and also helps with the education business. According to Dorsey, Dykes is a guy that really enjoys reading tax codes. I like him already, man. And figuring out the best ways to protect assets and save money. He constantly is learning and has passed on his wisdom to thousands over his 20-year teaching career. If there's one downside to Dykes, it's that it's hard to get anything done at the office because he's constantly answering questions for friends and students. And personally, I know that that's true because I've been on the other end of that generosity most recently. Not bad for a rocket scientist. With that, we have a short video for people to let you know how they like what you've done.
We just wanted to congratulate you on this wonderful RONI award. Well-deserved. All the teaching you've done, wonderful books, research, incredible.
1994, you put on a program called the Mobile Home Money Machine. And little did I know that was going to be the catalyst to let me leave the corporate world 5 years ahead of schedule.
You wrote an IRA book and I had bought it and called you with a question. You were so helpful. Words would not totally express my humble memory of that conversation.
His material is excellent, his delivery is superb, and he walks the walk.
He has so much wisdom, and he loves studying topics and sharing that knowledge with other people.
You've done such a great job of keeping us all up to date on corporations, LLCs, trusts.
You have just been an awesome influence on me and my business, our family.
He's brilliant. He's smart. A lot of people don't know. We call him, his nickname is the Professor. Another nickname is a rocket scientist. And a lot of people don't realize that Dykes really is a rocket scientist.
So truly I am no Shakespeare. Dykes, your teachings I hold dear.
Over the years, we couldn't be more impressed with your wealth of knowledge, your integrity, and a fantastic family man.
And Dykes Botiford has done nothing but help me, encourage me, and has really provided me with knowledge that's invaluable.
He's a valuable example and counsel to me and to many, many others.
Really, meeting you changed my life, not just in the amount of education I received from you, but in the people that have flowed into my life because of you.
There's a whole group of people, Dykes, that you will never know, that you will never meet, whose lives have been impacted by your teaching and by your leadership.
You've helped thousands over the years.
You've been a leader and inspiration for all of us.
Dykes has just been an amazing influence on our lives.
You've not only been a teacher of ours, you've been a mentor, and most of all, you've been a friend to us.
Congratulations again.
Thanks for all you do, Dykes.
Thank you very much, Dykes Botiford.
Thank you, Dykes.
Thanks, bud.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you, my friend.
Thanks for all your help.
Congratulations, Dykes.
This is no joke, so.
Yes. Thank you very much.
That's heavy. Thank you.
Thank you.
Thank you.
Wow. I was told to be ready for this, that it was pretty heavy, and he's exactly right. Thank you, Pete, for telling me that. And thank all of y'all for being here, and thank you for this award. I appreciate it very much. I'm reminded of Socrates when he went to get a haircut, and his barber asked him, "How would you like your haircut?" And Socrates said, "In silence." So I'm going to be very short with this, but I will tell you that if you ever want to learn something, teach it. You'll get enough questions that it will force you to learn all the nuances of whatever you're teaching. And I learned that early on, fortunately, and I've enjoyed the teaching. It's not only been an income stream, which obviously people understand, but it's also been a source of education for me. What's happening in everybody else's marketplace. And I was able to use that not only to improve my teaching, but improve my investing. So thank you all for this. Thank you.
Thank
and
you.
this is about the children tonight, so remember that.
Oh, you want to take a picture? Okay. You got it.
Thank you.
How about that? Okay.
Thank you.
Watching Debbie tear up was everything to me. Thank you for supporting what he did. Very important. All right. We're going to have 3 panels that will ultimately be up here. I'm going to do what's called an economic panel. We'll have 3 people up here with me. And then Aaron will do 3 that will have to do the tech world, which I can't be a part of because I don't have a clue, but Aaron does. And then collectively, we'll have a panel where I'll be asking questions at the end of the evening. All 6 people will be up there, and I'll do my best to try and engage everybody in something that's meaningful. We have a lot of very smart investors in the audience, and when I speak in front of you, I realize there's some concern. And so a lot of the questions that I've thought about to ask tonight has kind of come from you and what you've been concerned about. And so that's what we'll be doing all the rest of the night. There'll be 3 people I'll invite right now, and I'll introduce them one at a time, but they can come up collectively when I'm done. Jim Park is the CEO and founder of the Mortgage Collaborative. Jim provides day-to-day oversight of the Mortgage Collaborative business initiatives and works closely with TMC's board of directors to ensure that the company achieves its annual and long-term goals. With nearly 30 years in the housing and mortgage banking field, Park has held various positions in the corporate sector, starting several businesses, worked in federal and local governments, and helped to launch a number of prominent nonprofit organizations. Second on the panel will be Doug Duncan, Chief Economist of Fannie Mae. Doug is Fannie Mae's Vice President and Chief Economist. He's responsible for managing Fannie Mae's strategy division and economics and mortgage market analysis groups. He's a frequent speaker on national and state economic, housing, and mortgage market conditions. He's been named to the Business Week 50 Most Powerful People in Real Estate. And last for the panel, John Burns, CEO of John Burns Real Estate Consulting. John founded John Burns Real Estate Consulting in 2001 to help executives make informed investment decisions. The company research subscribers receive the most accurate analysis possible to inform their micro investment decisions, and the company's consulting clients receive specific property and portfolio investment advice designed to maximize profits. John co-authored Big Shifts Ahead, Demographic Clarity for Businesses, a book written to help make demographic trends easier to understand. We would welcome all 3 of you up to the top or the front. Right here. No particular order.
Oh, good. I'm off camera.
Why don't you move over this way? Yeah, we got to get him in there.
Okay. All right. I can see everybody. That's good. Where to start? Doug, I'm going to ask you a question, and some of this it'll be interconnected, and anybody that wants to comment, welcome to do that. Today, the U.S. economy has about a 2% GDP growth, a 50-year low unemployment rate, inflation under control. Why are bond yields so low? And we just recently inverted with those types of stats.
It's a great question. If I knew the answer completely, I'd tell the Fed, because they'd like to know too. Well, we're the best looking horse outside the glue factory.
Okay.
I was raised on a farm, so that's as a visual, but if you look at our 10-year, it's at, right now I think it's about 1.7.
Yep,
but
a little bit
most
less,
of
yep.
the developed countries in the world actually have negative rates at the 10-year. So we're growing. 2% growth is pretty good. Typically, economists think about the rate at which the economy can grow without inflationary pressures as being the sum of the growth in your workforce on an annual basis plus productivity gains. So we're not too far from that. We think that's about 2.25% going forward. So we're pretty close to that. So it's the U.S. relative to other countries around the world, pretty good place to be. The question of why inflation hasn't come, that's the issue that the Fed would like an answer to.
This influence outside of our own borders, are their economies likely to worsen and put more downward pressure on our interest rates?
That's certainly a possibility. China is clearly slowing. That is one of the effects of the trade discussion that's going on, is they're actually about twice as sensitive to trade as a share of their GDP as the U.S. is. And so you've seen recently some easing of credit conditions. Even some of that will flow into their shadow banking system, which is a real concern for them today. So there's no question that people are worrying about whether the U.S. is actually isolated from those effects of slowing in other countries. We're still the biggest economy in the world. China's second biggest. So as China slows, it does have an impact, but not as much on the U.S. as it does other trading partners of theirs around the world.
So looking at the Fed's actions, are the interest rate reductions in the U.S. kind of a preemptive rather than necessary?
So for those of you whose lives are so exciting that you watch the press conference of the Federal Reserve Chairman, there are all of the economists that, we typically form our cocktail parties around Fed press conferences. But so I do watch them because there are some clues. And in the rate cut that they issued in July, they called it a mid-course correction, which the suggestion then is that the economy is actually doing okay, but the risks are on the downside, so we'll just temper it a little bit, be a little bit easier on money. So we're listening in September to see, does he use the words mid-course correction, or does the word insurance show up? In fact, he used the word insurance, which suggests their view is that the risks are greater to the downside than they were. We actually have another rate cut in our forecast in December on the insurance idea.
If we go back a year ago when we had this meeting, the anticipation was we were going to have 3 rate hikes.
That's right.
Going forward. Now we're probably going to have 3 rate cuts.
Yep.
That's a big difference.
Absolutely.
Okay.
And real estate's feeling the effects of that, right? We saw the run-up in rates to that expectation late last year bled over into the market the first half of this year.
Okay. John, when I see that your business only was started in 2001, I mean, it's an amazing accomplishment, first of all, because when you got started, you had a nice run for builders, but when you and I really got to know each other, you invited me to debate 2 very smart people in 2005 and 6. At the time that went on, your clientele was basically builders, correct?
Yes.
And okay, I mean,
yeah,
so,
I had to pivot.
Well, and that's a great word. And I listened to one of where you were being interviewed, and that's a word that you use, and that's an astonishing pivot because almost all the builders that survived had to do exactly the same.
Yeah, and maybe thanks to you, a number of my builders actually sold their company before the real, hit the fan. So, nobody can time this stuff right, but I think you can figure out when the risks are higher than usual, and I think there's a parallel with what's going on right now. I mean, I don't know what's going to happen next year, but I'm confident the risks are higher than usual. And so that's how our clients are running their business again.
But as you expanded your client base, you've also added to your life kind of the input from very smart people across the board. And that, for you, that has to be a pretty cool experience.
Oh, yeah. No, I mean, I've got 250 of the smartest clients out there who pay us every month to make me smart. I mean, that's pretty good deal, so.
That's a pretty good business model. Has the urgency or animal spirit to own a home changed from when it was? Like when I was a young adult, man, that was it.
It's totally, yeah. I mean, I'll say it another way. I think the animal spirits to own anything has changed. In that demographic research book we did, it was very clear to me that we nicknamed those born in the 1980s the sharers because they basically invented the sharing economy. They're like, why do I need to own anything when there's an efficient way to rent something? And it starts with prom dresses, and it's been going, houses and Airbnb, and I'm just going to borrow stuff. I'm going to borrow a bike. I'm going to, take one of those go cars. Same thing with a house. I mean, they don't like rent hikes. They like to own. They would like to own their own stuff. I think most of them are going to become homeowners, but are they going to achieve the home ownership rate as their parents? I would say the odds of that are less than 1%. I mean, they're just not going to get there. And well, the reason I say that with some confidence is not just attitude. The GDP growth on the last 20 years has been a full point lower than the prior 20 years. So they just haven't had the same economic tailwinds.
Well, when you look at the numbers for people that retire with their home free and clear or retire as a renter, that's not a pretty sight.
No, I know.
Okay. So are they going to make that money in another direction, or are they not going to?
So let's look at it through their lens. It's not a pretty sight in their lens to see their parents get thrown out in a foreclosure. And when they hear the word if you're born in the 1990s, the word recession means foreclosure. It's the same thing. And so, I mean, they want to be homeowners, but my clients have done some really interesting research on that. A lot of them are not stretching as much as you would think. They'll stretch on the down payment. They're putting nothing down. But I still, I don't want to go up to my eyeballs, particularly in California, interestingly, and particularly the college-educated people in California.
And we see that in our data, the flow through our data, that this group has the smallest share contributing more than 30% of their annual income to buy a house of any of the last 3 generations. Much more conservative.
Yeah, I don't mean to say a lot of people aren't stretching, because I've got a lot of data to show people are stretching. But
what's the main reason to buy today?
It's because I'm ready to settle down and have a family, and I'm stable. And that's another part of it. The job, you used to take a job and be someplace for 30 years. Now hey, it's probably not going to be, and even if I want to be here for 30 years, it's not my choice. And even in big markets like Phoenix, but Phoenix is a good example. If you buy a home on the west side of Phoenix and then decide to take a job on the east side of Phoenix, you got to move. I mean, the traffic, some of these sprawl markets have really, and everybody's a dual income household too, so both of you have to have a job on the west side of Phoenix. It just creates a lot of psychological barriers.
Jim, what was the year the Mortgage Collaborative started?
We started about 6.5 years ago.
Okay.
Yeah, with a kind of a concept that we thought lenders could learn from each other, support each other's growth. So what we do is right now we have about 170 lenders from throughout the country that are members of the organization. We benchmark their performance against each other. We help to elevate their performance level in terms of our operation and efficiency. It's an important issue in this environment. Right now, the average cost to produce a loan is $10,000. It was about $8,000 about a year ago, and it was much lower. If you go back 5 years, it was much, much lower. Now, there were some issues around regulatory costs that were embedded into that added cost of producing a loan. But there's higher loan officer comp and other things that kind of that played out that makes it very hard for lenders to survive in this market. And frankly, a lot of our members were struggling at the beginning of the year before the rates started to drop. Everyone's feeling really good again, but as you know, in this business, it's a very cyclical business, and so we expect that to last for a little bit. I don't know. I'm not sure how long you think it's going to last, but hopefully it'll last a little longer. But it'll come back to that. The balloon will come back down again, or the bubble will come back down again, and so we're expecting to try to run the business more efficiently yet again.
So you'll ultimately rely more on purchase than now. So there's other avenues of loans. So is are you interested in, let's say somebody gets aggressive with loans to investors and stops saying 4 or 10, maybe that's 30 would be the number or something like that. Would that have an impact on your clients being able to make money?
The bulk of the business today, and Doug knows this very well, bulk of the business still today is a very safe and sound lending. And so sort of these aggressive lending products that are in the marketplace is still a small piece of the business. So I think just generally book of business today is better than ever. That's why I think a lot of people are concerned about the bubble and what the market will potentially hold a few years down the line. But you are creating some of the best manufactured loan we've seen in our history. And so I don't have as big a concern about the potential mortgage downturn in that same way. There are other issues at play in terms of the broad economics, but in terms of the mortgage side, actually bringing the economy down, I don't think we have that issue ahead of us.
Yeah, one of the things we track is what we call early payment defaults. That is when a loan is new, how many of those loans go into delinquency 30, 60, or 90 days, how soon. Those numbers are the lowest they've been in over 20 years. So to Jim's point, the quality of the loans that are on the books, and also to John's point, a lot of those are younger people that are being much more conservative. Partly it's the tightening of underwriting criteria that has supported that, but it is factual that it's unlikely that the mortgage space will be the problem next time around.
When you look at the current lending laws that are still in place, does it indicate that we're still going after safety first, or are we trying to get the percentage of owner-occupants up again, the people that own their own homes?
It's in Doug's point around kind of the low level of delinquency that we are experiencing in the market, historic low. It does sort of tell you that maybe it could loosen up a little bit. Obviously, that has a direct correlation to how wide the door is to let people into getting financing. Although I do find that people, and to the builder side, I think supply, I would say, what I've heard is that's the bigger issue, less so the kind of the credit availability in the market.
The supply of what?
Housing.
Okay.
Yeah. So I think that's a bigger issue. You got plenty of people looking for housing. They got financing behind them, but they can't buy the house that they want or afford. And I think that's been sort of the particularly at the mid level or the startup mid level. I think that's where people are struggling. And so I think we can try to create more buyers, but we got to find places for them to buy, right? So that's the challenge I think ahead for us.
I just want to bring some clarity to the mortgage thing, because this is what we were talking about earlier. Like, the mortgage underwriting isn't tight in every aspect. So the documentation is as tight as ever. So if you don't have great documentation, it's tough. If you don't have a FICO score of 640 or above, it's a little tough. It's a lot tougher than it was 10 years ago, but pretty comparable. About 10% of the mortgages are going to those people, and that was similar to the 1990s. So they could loosen on documentation, and they can loosen more loans to the sub 640. We have 57% of mortgages putting 10% down or less, which is the highest ever. So it's not the down payment is as loose as ever. And Dodd-Frank came up with an arbitrary number, 42 or 43%. We should not be above somebody's gross debt to income ratio. And except for Fannie, Freddie, and FHA, we're going to let them slide. So 43% of all mortgages are above 43% debt to income ratio. So we're not loose on down payment. I mean, we're not tight on down payment, and I don't think we're tight on debt to income either.
Yeah.
Go ahead. I think part of the reason why you see the sort of trending down of the down payment amount is because home prices have moved up, right? And so I think for people, I mean, you talk about an average, teacher or fireman and how long it takes them to get 10% or 20% down, it's quite substantial. And so if people want to jump into the market, I think that's only option they have is to go towards more of the low down payment product, and both Fannie, Freddie, and FHA, obviously, you have a vehicle for making that happen. So.
Yeah, but the point is that product is there.
Exactly. Yeah.
It is the thing that is different than in the 2004, 5, 6 time frame is that the underwriting process now is diligent about what they call layered risks. So if you have a spotty employment record, in today, it might be okay as long as you've got good savings and you have a good record on repaying your debt. But if you have a spotty employment record and a weak record on repaying your debts, and you don't have savings, you're unlikely going to get that low down payment loan, right? So the underwriting has removed those layered risks. We survey households, 1,000 a month. We've been doing that since June of 2010. And we then, on each quarter, we survey the universe of mortgage lenders. And we've watched the parallel recognition of both households and lenders of the pace of slowdown in credit easing. So starting at the post-crisis period in the 2010 period, credit underwriting was very tight. It's gradually been easing, and both consumers and lenders have recognized that. Part of it is our rules, so we're part of what's driving that. But over the last year, it's flattened out. And in the most recent quarterly survey of lenders, there was actually marginal tightening in every group except the part that Jim was talking about, that private label issuance, which is less than 5% of the total market. But there was actually slight tightening. FHA tightened a little bit of rules. The debt-to-income ratio that John talked about, we saw some layered risks emerging there. We tightened a little bit of rule. That was translated into the industry very quickly.
Okay. It's been in the news every night for a week. I got to ask, okay? Repo market. It's not a repo like we're used to. It's not a repossession. It's a repurchase, correct?
The Fed only wishes it was a kind of repo that you're thinking.
So there's been a lot of billions of dollars that have had to be added to shore up something. I'm not an expert on this, but I've tried to make myself a little bit familiar. Basically what happens is you have lenders that have money and you have lenders that need money. And what occurs is the lender that needs money actually gives up ownership of something. Is that accurate? Mm-hmm. Okay. And has to rebuy it within a certain tight time frame. Mm-hmm. Why was there a shortage of $75 billion in that exchange? And now it's going to what, October 2nd, and could add up to $2 trillion? Okay.
So I'm going to pitch watching the Fed press releases or press conferences again. I'm going to get at least one of you to join me, and we'll have drinks. Because liquidity, as we know, is very important, right? That's why you have drinks.
Liquidity or lubrication?
Well, either. They work together. So in the press conference, the chairman was asked, "Did this surprise you?" And he said, "No, because it happened in December, although at a much lower level. And so, but what did surprise us was the magnitude." And then he quickly said, "But of course it surprised the market as well." So then the question was asked, well, why? What's the cause? And he said, "We don't fully know." That's a troubling statement, right? But it's also an honest statement.
It's an honest statement,
That's
but
right.
we don't want him to do that, I guess.
That's right. So it is true that the whole capital markets community is attempting to understand this, and there's not a good, solid answer to it. If you really want to get into this, there is a guy named Zoltan Posnar that is an analyst for UBS, and he's been warning about this for about a year. I'm going to get a name change because Zoltan is a much better name than Doug. So,
it sounds like you know,
yeah.
right off.
Well, we had him come to the company this past week because we wanted to talk to him about this, because we put a lot of money, because of the mortgage payments that come through our business, we put a lot of money into the cash component of that repo market, right? And so we are concerned about the fact that it's difficult to understand. Part of it is the huge volume of issuance of treasuries that's having to be done because of the deficits that we're running. And there are 24 companies that have been granted access to the treasury. They're called primary dealers. You can look it up on the web and you can see who they are, 24 global banks. And they're the ones that actually execute the sale of treasuries into the market. And that's where the reserves either shrink in the banking system or increase depending on whether they're selling or buying. So that's one of the things, is the magnitude of the issuance of treasuries, and those institutions all have capital rules that say on a daily basis what their liquidity has to be. So they will go into the market, and if they need more liquidity, they will be dedicating some of those treasuries to the trading partner, who will then give them cash to meet their regulatory requirement. Then the next day they sell those treasuries back at an incremental nightly interest rate, right?
Right.
That's a piece of it. It's also the case that on a quarterly basis there are corporations that have to meet tax issuances. And so some of them access cash, typically through the money market funds, which also has to do with the reserves on bank balances, and that also happened.
What is their collateral? Is it bonds?
It's the same. It's typically treasuries or agency securities.
Okay.
So those are a couple of the things, but that's not all of it. And I'm not going to pretend to understand everything that Posner has written about it. I've been trying to make my way through it. We're trying to understand. He doesn't fully understand the elements, but he's been the one person who's been really accurate that this is going to be a problem. He suggests it will ultimately drive the Fed to expand its balance sheet and drive the funds rate to zero.
That was one of my questions. Is the act of what they're doing actually already doing that, adding to that balance?
So the follow-up to Governor Powell's question was, given that you're not fully sure, but there is a liquidity issue, you've said that you would start to let the Fed balance sheet grow organically. There was a New York Times reporter asked, shouldn't you give consideration to actually increasing it today to a higher level because of those reserve requirements, and then let it grow organically? And he said, no, that's not what we're going to do. There was another follow-up question that said, shouldn't you stand up a permanent repurchase facility?
Mm-hmm.
And he said, not at this time. So they're still trying to understand the dimensions of the issue, and it does have some global components to it, because some of those primary dealers are global bank components.
Okay. I'm sorry, but I don't, Aaron, do I have 3 minutes or 33 minutes? 3? Okay, that's what I thought. I'm just going to throw this out there because we'll come back to it later. When Lehman Brothers, we watched that movie, and I just want to know, when they came to the table and wanted money, was it the same type of meeting where they came, only the asset base that they had wasn't valuable and no one would exchange money for them? Is that in that world, or is that a different world?
It's sort of in that world.
Okay.
But there's some differences. The issue in that world was, and if you'll indulge me with a little anecdote, it's the single scariest day of my entire professional career. It was the second Friday in the month of August in 2007. And I had Michael Berman, who ran CW Capital, the biggest B-piece holder of commercial real estate in the country, called and said, I just had a $3 billion deal that evaporated, and I can tell you that market's not coming back. So we were sitting at the desk trying to figure out what do we do about this? Who do we talk to? Because we're not a regulator, we're a trade association, right? So then the phone rings at 4:45, and it's Don Cohn, who was the vice president of the Federal Reserve Board. And he said hello, and then he said, Doug, what do you think we should do? So, honest quote, I said, Governor, if you are calling me, it's a lot worse than I thought. Because I'm not at the top of the totem pole. But that issue differs from this one in that what was going on then, and this is what I told him. I said, I always redound to Economics 101. In order for an asset to have value, it needs to have a price. It's valued by its price. And to have a price, there has to be both willing buyers and sellers. And today, Governor, there are only sellers. So I think you have to be a buyer, which they did 11 months later, right? But it's because no one trusted the value of the balance sheets of their trading partner. That's not what's going on today.
Okay, that's what I was asking.
That's a different
Okay.
thing.
Okay, we've got to go sit down and give Aaron his turn, and we will be back up here to bat it around some more. Thank you.
Yep, look at you. Wow, right on time. All right, we're going to show your answer to how you're feeling about the economy. Opportunity.
Hey, how's that?
This is an investor crowd, so
That's
I don't
a
know how to
good group.
take that. They probably think it's going to crash and they have opportunity. I don't know. Good to know. All right, we've got another one for you. We are going to ask a different question. The quiz now is the iBuyer model here to stay? You don't have to retype in the Norris group to 22333 unless you haven't participated yet. But what you're going to be typing in is A, if you think yes, the iBuyer model is here to stay. B, no, it's not here to stay. Or C, what is an iBuyer? It's okay, I'm not judging. It's anonymous. We're not tracking you. With that, I'm going to call up our next three panelists. Mark Leswing, he's the Senior VP at T360, a management consultancy firm in the residential real estate brokerage industry with a specialty in technology. He's done a lot of research on blockchain technology. He's a blockchain entrepreneur, and we'll be talking about that tonight. Simon Chin, the Executive VP of Innovation for Realty. Simon has recently been appointed to head of a new product, an innovation for Realty. It's all right. Let's go to the slide, and then we'll come back. He's fresh off of being president and CEO of the ERA franchise systems. He actually walked here tonight. He lives in the neighborhood. What are the chances? And last but certainly not least, Sean O'Toole, founder and CEO of Property Radar, now in his 11th season at I Survive Real Estate, our longest running panelist. He is the founder of Property Radar, the property data owner information platform real estate pros have trusted since 2007. I use it every day. Please come up, gentlemen. Glad to, and if you could all give them a warm welcome. Okay, let's now go back to the slide of the iBuyer. How are, if people think that the iBuyer, yes, no, and okay. We have to talk about the iBuyer. Simon, since Realty is dabbling in the iBuyer space, would you like to give your definition of what an iBuyer is?
Sure. So there's a number of competitors in the space now that are talking about iBuying. In sort of brief terms, it's basically the ability for a seller to be able to sell their home in a very rapid fashion, usually in a span of 5 to 7 to 10 days or so, right? Typically, it's at a discount, so usually the buyer of the property, it's sort of a bit of a misnomer, is an investor, right, that is looking for very specific parameters around what they would be willing to pay for these properties so that they go very quickly. The practical usage for the seller, obviously, is people that can't be bothered with selling their homes because they don't want to clean it out. They've got 20 years worth of stuff that they've accumulated or what have you. Or, folks that have a contingency on their homes, or folks that are relocating or moving to, some other property or something like that where getting rid of their property is contingent upon moving to the new place. So that is sort of the dynamic that's out there.
They're basically getting in our space. All cash, fast, flexible, nobody's walking through the house. I think I was speaking and a realtor came up to me and she's like, I got a call at 8:30 last night. Somebody was in front wanting to see, and she's like, you'll have to wait till tomorrow. And they're like, but it says that I can just come in. There's an app. I can let myself in. And the agent was very uncomfortable. They had just been cut out of the chain. So this is Wall Street money, backed by lots of technology, and when we're talking about the kind of money, up on the screen, you've got some of the players. Open Door, only around since 2014, yet they've raised $1.5 billion. They just announced this summer a partnership with Redfin, and it's no wonder. They have been spending millions of dollars on advertising on all the markets they're in. OfferPad has been in California for a few years, but started in 2015. They've raised $115 million. Nick Bailey was here a couple years ago just touting that Zillow absolutely not would be in the iBuyer space. And they threw their hat in this year, and they've gone pretty hard, pretty quick, at least here in California. Keller Williams announced early, I think it was about a year ago at InMid, that they had secretly done about 100 deals, and this summer announced that they'd be working with OfferPad. NACA's not yet that I've seen in California, but they've raised a total of $430 million, been around since 2015, and then NRT is a brand of Realty, and you've got the Catalyst Cash offer, and you've been around since about, well, how long would you say Realty has been around? You are the parent brand for, can you rattle off, I was not aware of Realty as a parent company to all these brands, but can you share the brands?
Yeah, so the brands under Realty. So not a lot of people have heard about Realty because we don't go to market as Realty, but you might have heard some of our brands. We own Coldwell Banker, Century 21, ERA, which is what I formerly was heading up, Better Homes and Gardens, Sotheby's Real Estate, as well as Corcoran. So we represent about 18% of the U.S. domestic residential real estate market.
And that's a lot of money really quick. Sean, you work with real estate investors every day. Is there a sense of like, they can't do what we can do? Is there a Wall Street arrogance about the iBuyers in the space? What do you think?
Arrogance? I love which one was it that you said just closed in on 100 deals?
That was Keller Williams secretly behind the scenes.
Keller Williams. So, there's 6 months, they'll catch up with me. And another 20 years, they'll catch up with some of the folks in this room, right? Yeah. And I guarantee we all had better margins. So, there's too much money out there chasing too little return, and, they'll put that money behind folks that went to really good schools and can build really good models rather than people that, are actually out in the marketplace doing things. And I think that probably this room has a lot to teach that group. I think they're going to, I don't think as it's being executed right now, it's a well thought out plan. I think of, what was the Tyrannosaurus Rex in the, what movie was that? Like, Master, this isn't a very good plan.
Is that Toy Story?
Toy Story.
No, was it Toy Story? I don't know.
Toy Story, yeah, Toy Story.
I belong to several associations, and I've talked to some of the iBuyers, and they're very young and very hungry, but there's a sense of competitiveness that's happened as well. So my question to them was like, how are you feeling about this brand entering the market? And they're like, we'll get them. I'm like, I don't know if that's a good strategy. And I do have real estate investors that are actively pitting them against each other as they 1031 exchange outside of California. So they're purposely getting offers from every single one of them, taking the highest and best. And for the most part, I'm hearing they're really happy with the offers. So they're like, they understand this model. So when I spoke to Open Door about 6 months ago, I'm like, why aren't you working with real estate investors? And at that time, they said that the brand was so important to them, they didn't want to work with, Main Street. They were Wall Street, they were about scale, and they're spending a lot of money on advertising. But I do think this summer, them announcing the partnerships with Redfin was really important. I've heard that Open Door is one of the only iBuyers up in the Sacramento market. They are spending hundreds of thousands of dollars every month and no home for the leads for things that they couldn't buy. That's horrendous. But let's get to vertical integration, one of my favorite Wall Street words. Because maybe they don't need to make all the money on the buy-sell side of real estate. Maybe it's because they're opening up lending offices, closing businesses. Mark, you've been in this space for a long time, and I know this isn't why I had you on the panel, but T360 is really well known for all their research, so you are joining some fantastic company. Really nice to have you here. Is this a big concern for a lot of the clients that are looking to T360 for research? Is there a lot of pressure for every real estate brand to get into this business?
Yeah, there's always a lot of pressure, but I'll tell you, a lot of this iBuyer stuff and all the other things that have come along, just when things seem to be calmed down, we have to always invent something that gets a crisis mode, and then it calms down. So it's kind of the thing right now that everybody's looking at. So you do have to address it all the way up and down, getting into other businesses, how do you make it more efficient. But this too will come to pass, and then some new crisis will come up after that to occupy everybody's space.
Well, then let me ask it this way, and we'll go down the line. A lot of these brands have not been around since 2014. It all works until it doesn't. Are they recession-proof? If there's a recession that hits and the prices start going down, even if not a lot, will they survive?
Yeah. So one of the innovators, I guess, in the space is Open Door. They've received a lot of money from SoftBank. You might have heard about SoftBank recently. There was this little company called WeWork that didn't go public over the last couple of weeks or so, and their valuation went down over 80% over private money valuations in the last couple of rounds. So we, as actually profitable operations, are looking at that, pretty, with a fair amount of interest, because we want to see if this is, 1999 all over again, basically, where the private equity investments into a lot of these companies is going to sort of turn around and bite them when they try to, get public investments into them. So the net from our perspective is there is certainly a place. We're brokers. We have 300,000 agents globally. There is certainly a place for people like my dad, for example, right, who is very concerned that he does not pass along a legacy of debt to the kids. And therefore, if he needs to go to senior housing, for example, right, he wants to be able to turn his house easily without burdening us in any way, shape, or form. And I'm like, hey, Dad, I'm a broker. Like, we could sell your house, no big problem, right? But for him, he doesn't want to burden us at all, right? So I do think that there will be some portion of the market that wants to sell their house at a discount for convenience. Just like you go to 7-Eleven to buy that pack of gum instead of Costco because you don't want, 8,000 packages of gum at your house, but the unit cost is very different, right? So I think there will be a role for it. Some people are saying that it could be as much as 60% of the residential real estate market. I don't happen to believe that. I think it's going to be more, when it all normalizes after 10, 15 years, it'll be more like, 10, 15% or so.
Okay. Yeah, I've heard the 60% number too. Yeah. Sean, are they in or are they out?
Well, so first of all, I totally agree that they are addressing a market need, right? Like, there is a reason why so many folks are pouring so much money into this. Like, the normal house sale process, it's difficult, time-consuming, expensive, and I think, and so to your point on vertical integration, right, to the degree they can pull in title and mortgage and other things and build that into their stack, right? I think that there is an opportunity for savings there. And we saw that in the trustee sale business. I have multiple trustee sale customers that started to vertically integrate as the market got more competitive, right? So, okay, I can't make as much money at the sale, but boy, if my construction company does the repairs, one even went so far as to have a title company and a mortgage company and the real estate brokerage, and you roll all of that in, maybe there was zero profit on the flip, right? But the profits on all those other pieces still made that business work. So I totally, believe that you have to have some level, especially with this level of competition, vertical integration is going to have to happen. I still think that maybe what they're paying for properties in order to try to prove out their model is certainly not sustainable. There needs to be more margin there. And, as we all know, right, you let the margins get too thin and you take more risk and you get hurt in a downturn. So I do think that they face a lot of risk in a downturn.
I'm using Property Radar to track every buy-sale transaction for all the major iBuyers. I'm that nerd. Yeah. I love Open Door because it says it puts it on their credit line. Every time they buy, it's like $400 million. I'm all, wow. Yeah, geez. Mark, what do you think?
I think if you look at the motivation behind the iBuyers, once it does calm down, I totally agree. I don't know if it can ever get to that 16 because I think it's going to take part of the market that's the FSBO market today. And that FSBO market, you got 12, 13%. So it's going to be a percentage of that. So I think it's even going to be lower. I think it's going to be more near 5 to 6%. It can't take over the FSBO market. But the buyer or the seller there is kind of motivated by the same kind of things that you find in iBuyer.
Yeah, and I think there is going to be real estate investors that there's going to be stuff that they're just not going to buy. Craig in our office calls them situations, and he often uses quotes. It's the messy stuff, the people who put up the duck wallpaper or the grapes in the kitchen. They're like, we just put that up like 20 years ago, and it's not worth $20,000 more. So complex probate transactions, so I don't think they're going to be taking over all the real estate investor transactions, but definitely there are competitions for realtors and investors, especially if we don't keep up. Yeah. That leads into disruption. And you just got named a pretty big role in Realty. What does a good investment in technology look like? You've got Keller Williams that over the last year says that he's planning on spending $1 billion. where do you invest $1 billion in technology for your agents?
Sure. So, number one, not to incite a riot from any Keller Williams folks in the room, but, that billion is sort of the amount that he's investing, but it isn't necessarily being spent in any sort of defined time frame. We at Realty actually spend about $200 million a year on real estate technology, and that's, for our investor or for our agent population. So, where do we spend the money? Right now, if you look at real estate technology. Actually, let me back up a second. So I'm reasonably well connected in the real estate world, right? And I buy a fair number of properties a year. I'm an investor myself. And frankly, the experience is kind of crappy, right, for consumers. And so, one of my great passions being in the industry for the last 20 years or so is how to make it a nice experience. And a place that I shamelessly spend a ridiculous amount of my, income is Amazon.com, right? So why, and I'm sure by the time I get home tonight walking, right, there will be a wall of boxes in front of my door that I have to bring inside when I walk in. And the point to that, though, is that, they create value. Otherwise, we wouldn't be spending money there, right? So how do we make the consumer experience more like Amazon.com? Because I think we would all agree that the consumer experience is far from it right now for real estate purchases. And that's, I think, the direction that we're moving in, right, is actually applying more modern technology so that the consumer experience is a lot more intuitive. There's a lot more transparency for the consumers, kind of like there's increasingly being on the mortgage front, where you can actually see what's going on in the transaction. You can sign your forms online. You can see the workflow, the contingencies, and everything like that all online. And then, heaven forbid, once you close escrow, that whole home ownership experience, basically the Amazon of home ownership for the consumer, is all on the website as well. So like if you ever need to pull your documents for your taxes, or if you ever need to see like what the heck is installed in your house and whether you maybe should anticipate getting your air conditioning service before it ends up costing you 4 times as much because it's hot outside, those sorts of things should all be within that experience, right? And your engagement with your realtor over that 9 out of 10 years that you're not transacting is all sort of in there. So I think there's an awful lot to still be done on that front, and that's a big part of the load that I'm bearing right now.
I'm glad you went that far deep into the sales process. So a lot of people think that the sale is over when the transaction stops.
Sure.
But what you're talking about is taking it all the way through further. What it feels like is that there's a lot of pressure for real estate brands to, once you enter an ecosystem, you're controlling it, not just for the first transaction of the buy, but much further down the road.
Well, so the interesting stat about that is, so yes, ideally, right? You hope you would get a consumer in and then they're yours forever, right? But the numbers actually belie that, right? So 90% of consumers say that they would work with their agent again right after they close escrow, right? So, hey, congratulations, you got the key, we're so happy, boom, 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 boom. The actual percentage that end up using that agent again after 7 to 9 years, depending on whose data you're looking at, 12%. Wow. Right? So if my technology that I just described can help bridge that gap between 90 and 12, we're dancing in the streets as a publicly traded company, right? Because we're suddenly capturing a tremendous amount of business that we don't have to go out and refarm again.
All right. Sean, what do you think real estate investors and realtors should be focused on? It seems a little overwhelming when you see the amount of vertical integration that some of these huge brands are pouring a lot of money behind. And not all of us are behind, just $1.5 million credit card, spending money on technology. What do you think we should be focused on?
Probably not that. At the end of the day, right, if you focus on your core business and find efficiencies in your own business. Like, these guys are trying to find efficiencies on a massive scale, but we can all find additional efficiencies, right? Like, I think that is one thing. A lot of the trustee sale customers, like I said, started to vertically integrate themselves. Sure, maybe it was on a small, scale, but if you're doing if you're a larger investor flipping quite a few deals, it's not out of the question to own your own construction company, to own your own even title agency, right? That's possible. But there are a lot of things you can do. I even think maybe it's interesting for real estate investment groups or clubs to start thinking about sharing things.
A little closer. Yeah.
A little closer. So, you know, we can all be a little more efficient, and I think that's one thing we can take away from all of this. In terms of, you know, are these going to completely dry up every deal in your area? You know, to your point earlier, there's, you know, the hoarder houses. There's still going to be all these things that these guys aren't going to want to touch, right? They grew up on Wall Street. They went to really nice schools. They want nice, clean houses, kind of like we used to buy in, 2009 when that first wave of foreclosures came through, and you got brand new houses that were 2 years old and the carpet was clean.
We made a joke last year at I Survive Real Estate. Would you have brands like Amazon and Home Depot come up with the Sears catalog? You and I had talked about this as well, to where if Amazon gets in the game or Google, Amazon invested in a company called Plant Prefab. If you listen to our radio show, one of the reasons I interviewed them was because Amazon was investing in them. Berkshire Hathaway owns Clayton Homes. You've got some very big money behind prefab, and I'm just really interested into why. But what if Amazon starts listing homes that you can just get delivered on your back door? In some cases, you already can, but they don't have water and toilets. So just careful what you buy. You're like, I can buy a house for $8,000. Yeah, it's basically a tree house. I don't want to go too deep into this, but one of the reasons I wanted to bring you in specifically last year as well. You spent 17 years at the National Association of Realtors, and you were on a radio show a couple years ago talking about blockchain. Sean and I were talking about this before, and Simon and I talked about it a little bit as well. You're really deep in it. Is anybody in this room ever really going to touch blockchain and understand what it is? Or is it going to be one of those things behind the scene that it's just really cool, it's secure, and we're good to go?
Well, first of all, the best news is you'll never have to worry about touching it because it's actually going to be buried in the applications. But I can probably describe what blockchain is. So you can go home tonight, I can do it in under a minute.
That would be amazing.
All right. Okay, so buckle up, here we go. So if you had a driver's license, it's pretty clear. All the fields in the driver's license, you have like 15, 20 fields. You can't add any information to that, right? That's a database. You could probably list all the information in an Excel spreadsheet, very rectangular. Now, as you go and drive around a little bit and you get stopped by police, whatever, you have a driving record. There's a number of things. It's like a chain of things. Some people have a long one, some have a short one. That's a blockchain. So a blockchain is a record. It's a log of what's happened versus a driving license. So driver's license, driving record, database, blockchain. All this other crypto stuff is crazy.
Definitely the easiest way I've heard it described.
Yeah.
2 years ago, I interviewed blockchain.info for a report that we were writing, and he's like, yeah, you're not going to see it in the United States. We've got a lot of bureaucracy in real estate. You basically have to get the Appraisal Institute, ALTA, the National Association of Realtors, the Mortgage Bankers Association. We'd all sort of have to agree, and what I'm seeing right now is title companies sort of creating their own private blockchain, and that sort of seems like not what the technology was supposed to be.
I totally disagree because if you think of things as a driving record, every offense is just chained out there. Therefore, I think if we try to use blockchain to rip apart all these repositories, whether they be MLS, title, lending, or even the county records, we've done ourselves a great disservice. But actually, it can actually help you move the transaction across them, and therefore making vertical integration, as we talked about before, more of a reality. Therefore, it'll help what we're doing. It does not replace it. Therefore, I think it's foolhardy to think that we'd be replacing all this stuff with blockchains.
We're just going to make it more efficient by adding
Absolutely.
blockchain. Okay. I was going to try to find a fun way to do this. We've got about 5 minutes before dessert. Chocolate's on the table. I was trying to think, do I play this? I have a 10-year-old I'm raising, and they really have to be in the real estate industry. What sector would I send them to? Or do we play a nice game of marry, cuddle, kill with all the different sectors? But let's just talk about some of the, that was a much nicer version. Some of you are laughing. Let's talk about the industries we think that are really going to be disrupted and probably go away, whether it be because of artificial intelligence, blockchain, whatever it is.
And now we got to start.
I'll go.
We'll start on this end this time.
Okay. So the things that get disrupted, is anybody making money out of holding on to data and then making profit off of your data? Therefore, they take your data, put it someplace, then they make money out and never give any money back. That is going to be out. Therefore, the concept of data as labor, your data is your labor. You should be rewarded for it. These new technologies can track where all that data came from, and we should change the economic model.
Uh-oh, he's thinking.
So I'll
Go ahead.
All right, I'll go. So back in the day on the real estate agency side, right? A big part of the value proposition for agents was showing properties, right? You had the secret book of listings. You had the secret book of this or that. Obviously, that's gone the way of the dodo, right? So, and you're seeing that more and more. Companies like Zillow, for example, have effectively made leasing agents, right, obsolete, because you can actually generate more leads just throwing it up on Zillow than you could putting it up on your MLS. So I think those within the next few years, basically, will be an obsolete life cycle. It's kind of like the toll booth operators, going up and down the orange corridor, right? I mean, like, why do that anymore? You no longer need that. So I think those folks are going to disappear within the next, couple few years. Wow. And they're going to have to focus on higher value functions. And I'm okay with that, right? Like if those relatively low value functions, if your claim to existence basically is that you happen to have the brochure that nobody else has so that you can claim that those are your listings, you're going away, and I think that's okay.
It was really interesting to watch Purple Bricks pull out of the U.S. market this year. They were based out here in Irvine. Wow. Apparently we don't have big fans of Purple Bricks in the audience. I thought it was really early. I was actually very surprised, but they had gotten hammered on stage saying they were, I forgot, it was at an Inman conference. Somebody said they were like plumbers that couldn't represent anybody, but they got really hammered. But from a listing agent side, for people who don't think it brings a lot of value, isn't it weird at this time in the cycle that they got pushed out? Is it just because they burned all their cash and they just didn't have a good business model, or what was it?
Well, yeah, I mean, the U.S. market versus, say, the U.K. market and the Australian markets function very, very differently, right? And so to be able to compete in a more of a sort of, an open market economy like they do in the U.S. and run the same model is not going to be successful, right? And the thing that I actually sat on a panel at the DOJ with the CEO of Purple Bricks, actually, in Washington. And the problem that they have is even though they claim to provide full service, the difference between full service and actually providing full service from our perspective as a brokerage is very, very different, right? Their folks are all about, their average real estate agent does about 250 deals a year, right? Whereas your average real estate agent without a team cannot do anywhere near that and provide any sort of service, right? And that was something that became quickly evident. He actually said on the panel when the DOJ attorney asked, what happens if a client calls you and asks you to, help them trim their yard or paint their wall or something like that to get a house ready for sale to maximize their profit? And he said, I don't have time to answer their calls. He said that in front of the government. So I mean, I found it appalling actually that, and it's in the public record so you can look it up. But I mean, that's, you cannot effectively scale to that level with those kinds of costs, and that's why they left.
All right, we'll end with this. Real estate or otherwise, what is the most exciting technology that you're watching that you think will be disruptive in the next 5 years?
5 years.
5 years.
5 years is a little tough.
All right, give me a time frame. It's okay. It's short.
Probably the one I think will have the biggest disruption that people don't really realize, because we've been from 3G to 4G, whatever. The move to real 5G, if we really deploy it, right? Like,
real 5G.
Yeah, my phone pulls up and it says 5G, right, from AT&T, and it's like, what is this? This is a joke. But if we deliver on the true promise of 5G, where there's very low latency, latency, if you've been on an international phone call and you have to wait a second to hear, for the other person, that's what latency is. So that gets tighter. It really changes quite a bit, right? And I was trying to come up, yesterday with good examples for you. But you think about augmented reality, right? Like the glass holes, the Google glasses, and things like that. Well, now you can start having that where you can have a full overlay of a lot of information, real time talking to servers, rather than having to try to have all that computing power on you. And I think it's going to be a bigger transformation than the internet.
Yeah, Amazon just released the Ring. We're going to wearables. I really think that we're going to be getting away from phone screens in the next 5 years with all the push for wearables for sure. And 5G, I think, will lead the way.
Yeah, and 5G allows you to put all the computing power somewhere else so you can have less battery power, smaller devices, and a lot richer functionality local. And so maybe that's the end of the phone. It really is going to be disruptive. I don't think in 5 years. I think in 5 years in parts of the world that are actually investing in things, right? We're laggards now on technology from a large infrastructure basis.
Okay. Mark?
Yeah, I think in 5 years, although it won't be fully out there, I think the autonomous vehicles, as it applies to trucking, will be interesting to follow. Because I can't imagine, if you don't have cab forward anymore, what it's going to do to all the shipping bays that are out here. Because you could pull the truck in either way. You know, it's a lot of design will change as far as warehousing and commercial property.
It's interesting because the Inland Empire has a lot of warehouse, and because if 5G comes on, all of a sudden all the jobs that people are touting, a lot of that can be happening via 5G connection. In Minneapolis, Targets, that's where they're based. They could be controlling entire warehouses with robotics and internet.
The trucks themselves might be the warehouses.
I'm uncomfortable. Okay, Simon.
I kind of agree with Mark. Like, I'm a big fan of the potential for automated vehicles, but less so for the commercial shipping and more for just all the cars on the road. Like, imagine if all of them actually knew how to drive, and the efficiencies that you could gain from that. But the lady that's responsible for this haircut, which is obviously not very expensive, she bought a Tesla and she spent like 70 grand for this thing. And, I don't know how much she makes, but I'm not paying her a lot. And, and she said that her Tesla, she got the automated driving thing, whatever it's called, so that Elon Musk says that in the next couple of years, that car can go out and make money as an Uber driver by itself while she's cutting hair, right? And I think that's fascinating.
Yeah, when you're done with your lease, the car will drive itself away and the new one will show up.
Exactly. Yeah.
But there's a lot of people that cry because they realize how many more cars are going to be on the road. So for here in California, I have people that say, oh, the traffic's going to be way better. And other people are like, are you kidding me? It's going to be so cheap. Families are going to not be taking their kids to soccer anymore. They're going to be just sending the cars. So you're going to go from a 2-car household to maybe more.
But think you could have because you don't have the way that's oriented, an autonomous vehicle, you can actually buy like a 17th century coach and go around like a king or queen of France. Because of the way the doors open and everything, it'd be fantastic.
Okay. All right, so Dad, I'm handing to you. You have to translate all that to how it impacts real estate and how we live. With that, thank you. We're at dessert time. We are going to start back at 9 o'clock for our last hour. Thanks, guys.
The Norris Group would like to thank its gold sponsors for supporting I Survived Real Estate. Coldwell Banker Town & Country, In a Day Development, Inland Valley Association of Realtors, Keystone CPA, Las Brisas Escrow, LA South REIA, Michael Ryan and Associates, NorCal REIA, NSDREI, Orange County Investment Club, Pacific Premier Bank, Pasadena Phoebe, Rick and Leanne Rossiter, Shenbaum Group, SJREI, Spinnaker Loans, South Orange County Real Estate Investment Club, U-Direct IRA Services, White House Catering, Wilson Investment Properties.
I'm going to end the way I've always ended the event, asking one of these two questions, but I'll put it in your guys' brain right now. Anything keeping you up at night, like a black swan event? And what's the one thing you're most excited about for 2020? So at the end, we'll respond to either one or both of those. There is a question I wanted to ask I haven't asked before, and we can just quickly go down. We'll start on my left. And your favorite source for information, newsletter, podcast, for learning and understanding?
You know what? There's so many, out there. I use this little app called Flip. What is it called? I think it's Flip, right? Yeah. Right. So it just and that's I'm actually playing into this whole I'm building an ecosystem of stuff that I only want to hear about, right? So it pulls data or information news on things that I pre-select, and instead of someone telling me what to look at, I pre-select it myself. And I actually flip through that literally every morning for about 15 minutes, and I can kind of get all the highlights, and I can start my day. So I like to use that app to kind of get it going.
Now that's for information, or I'm trying to think of maybe I'm not asking it exactly right. Like the people you rely on to tell you what's coming, maybe that's even more specific? Like a trusted direction.
It is so hard. I mean, that's a tough question. Nowadays, we're able to grab information from so many different places. I just don't feel like I go to one place anymore.
Okay.
And for me, it's if it's an issue, whether it's politics or economy or whatever, this particular app allows me to kind of look at all the articles that have been written about certain topics. So then you can just read about it from a different perspective. I just don't know if there's anyone who, aside from Doug Duncan, I would say I don't really listen to any other economists. So I don't know.
Is that going to be a unanimous thing? That's pretty cool.
People got to raise their standards.
Yes.
It probably sounds incredibly shallow, but I mean, I have Facebook up on one of my monitors all day long, and I have a good-sized sphere, just having run ERA for quite a long time. And so honestly, your sphere on Facebook is sort of, your peers or people that you respect or that you acknowledge or what have you. And so things that bubble up that seems to be resonating with them tends to, create more awareness on Facebook. And so as shallow as it sounds, I think that's where I get an awful lot of at least what the headlines are. And then I'll click down into, them more to figure out some of the details. Although I do have flipped on my watch. So
Oh, you do have it?
I do. So,
yeah.
you can check out my watch.
I actually love it. You're able to just instantaneously get all the information you want from lots of different sources. So.
All right. I've been out of I don't have not one flip, not one.
You don't give a flip?
Yeah, I'm more of an open sourcer. I've been kind of an open source software developer for so many years that I kind of go to this crowdsourcing type model. So I actually read slashdot.org. So slashdot is the word, .org. And they have articles that are really wide-ranging, and I get to hear from people that I've worked with all my career weigh in on different things, so it's kind of a way to get opinion.
Okay. Sean?
Just to be different, I read a lot of science fiction. And it's amazing. Like, a lot of my thoughts on cryptocurrencies and digital currencies, which I know Aaron's interested in. There's a great book, Cryptonomicon, and most of these things that still seem out there, or that we've seen recently. The internet, cyberspace, all these things. They were all in science fiction first. Right, and so I always think about what of those things are close. I mean, not for daily news, obviously, but it's a source of inspiration.
One of the things I'll mention is that for almost 10 years we've been riding in the limo, and most of what he told me was coming I never even had heard of 8 or 9 years ago, and he's talking about 3D printing and self-driving cars, and I'm just like, what is he talking about? And now here we are. So I really like our rides, because you never know what he's going to say, and I'm a big believer he's probably right. I just got to figure out if I can even comprehend what he just said. Yes.
I'll go. Well, if Doug had a podcast, I'd be listening to that, but he doesn't. So I'll go with Nick Timros from the Wall Street Journal, because I know him very well and trust him. And he used to be the housing beat reporter. Now he's the Fed reporter, and I think he calls it like he sees it.
I'm sorry, his name?
Nick Timros.
Nick Timros,
yeah,
okay.
And I follow him on Twitter. And he tends to like articles and comment on them with some good intel and disagree with people with facts, and I like that.
I talked to him a lot during the foreclosure crisis, and I talked to a lot of reporters, and he was definitely one of the brightest, so I could totally see that.
Yeah, he's the Journal's Fed reporter now, too.
Do you listen to yourself? Is that it?
Nobody else in my house does. Maybe the dog once in a while. I read these things, they're called books. They have like hardcovers and pages, they're printed on paper. I'm a liberal arts guy, so most of the reading that I do when I'm not in the office has nothing to do with economics. So I write history and biography and world events, and because I think that the world of ideas, it has a lot to offer economics from people who are not economists, and so I do that. In terms of daily news, I read both the Wall Street Journal and the New York Times every day. And I like things in print. I haven't watched a television news program in 20 years. And in terms of the business, I read, there's probably 6 or 8 other analysts or economists that I read because I certainly don't know everything. And I like to see the people that differ with me because it tells me I might not have thought about something. And so I try to do that.
Okay. No YouTube fans. I'm just curious. Am I like a college kid? I actually like that source, and since you guys would understand it better than I kind of got into it, and I wondered, I wonder if I could listen to Jim Rohn teach the same talk he did in 1981, and lo and behold, it was there. And I went, oh my, that's unreal. That's awesome. And then it connected the dots to other similar people, though. And that I didn't expect. And all of a sudden now I'm introduced to other people that are big influencers.
I did discover there was at least one incident of very useful YouTube. Our 16-year-old Ashley came walking into my office one day and she's looking at her phone and she's looks at me, she looks back at the phone, she goes, you know, you're actually funny. I'm justified forever, a 16-year-old.
Okay, so now we're back to the business of business here. Doug, you and I, you invited a number of investors. We went to Washington and spoke to Fannie Mae, and it was interesting, at least from my perspective. The first meeting seemed like it was a little perfunctory, and we were, not really taken seriously. By the third one, there was a very different meeting where they had separate groups, and they went and they discussed it, and they came back with really good questions. So I wanted to know what is your sense of Fannie Mae's attitude toward growing that side of the business to investors, and the other thing is, what is the journey to going to a private company again?
Well, as you probably know, the regulator has said that we can't do any business outside of our current footprint, which is the 10 maximum loans to investor. That is a rule that has been imposed on us by the past regulator. The current regulator hasn't said anything about that yet. Because he's been focused very much on what it would take to release us back into the private sector in a more competitive market. So I think the most important thing to watch for is the issuance of the capital rule, which has been a matter of a proposed rule and taken commentary from the public on that proposed rule. Then they will have to issue a final rule. When they do, it suggests to private investors what level of capitalization and the potential returns that we could offer to a private investor. So that's the first thing that has to happen. It may happen this fall. If the rule is reissued, that will delay the whole process. But there is a move to allow us to start to retain some earnings, which would build capital. Because the two agencies, Fannie Mae and Freddie Mac together, given the current level of capital, which is $3 or $4 billion, would need to have many, many times that. In fact, a single capital rule would be the biggest, single capital raise, if they were attempting to recapitalize both agencies in one raise, would be the largest IPO in the history of the United States. So that's simply not going to happen. So they're making progress in that direction, but there will be some time.
Okay. John, wanted to ask you about, I want to kind of deal with the household and then go into the rental market. So how is the makeup of what we think of as a household? You know, when I was a kid, it was, 2 kids, 2.3 kids, two adult parents. So what is the makeup now of America's household, and does that lend itself more to more rental households?
Well, I do think we're going to see more rental households. Some of the data is just like one line, like number of people per household and stuff, so it's very misleading, but you got to drill into it. So the seniors are going down, the number of people per household, but they are tending to rent out rooms in their house. That's the fastest growing landlord at Airbnb is seniors with a mortgage. And I think you're going to see, someone just raised their hand over there, that's me. No, seriously, this is going to grow. There's more than, conservatively we calculate there's 44 million empty bedrooms in homeowners' homes right now, and people are retiring and need another 10 grand a year, and I think you're going to see a lot more of that. And then the baby boomers are really the only generation around the world or ever in America who left home as soon as they possibly could. Everybody else stayed with their family.
As long as they possibly can.
Yeah. Well, if you look around the rest of the world and you look at the people that are moving here, they live multi-generationally because it's smart and I like my family. And I think we're going back to that. I mean, we make fun of some of the millennials with living with mom and dad, but mom and dad are okay with it. The millennials are okay with it. It's saving money. It's smart. So I think you're going to see bigger households when you strip out that retirement who's become single because one person passed away.
Okay. The businesses that got involved in buying rental inventory, first round of homes were bought below replacement cost.
Right.
Were most of those bought to keep or to flip?
You should ask the audience. That would be one of your poll questions here. In fact, I did ask the audience this last year. You let me do that. And if you for sure, home prices were falling this year, would you be a seller? And most of you in the room, when I asked that, said I would not. The big institutions are not. They cannot because they have bonds secured by all those real estate, so they cannot. And if you're a REIT, there's a huge tax penalty if you start doing it. So there's no threat of Invitation Homes or American Homes for Rent playing that game. But what you're also alluding to is a part of our business that is just ridiculously exploding, which is this new trend to build homes with the intent to rent them out. It's not happening here in California, it's happening around the rest of the country. So the whole thesis of buying below replacement cost is shot when you're building it. But there's a lot of capital on Wall Street in this environment that says, hey, if I can get a brand new home with low maintenance and a yield of maybe 5 or 6%, I'm feeling okay about that versus some of the other investment opportunities that are out there. And there's a lot of money chasing that deal right now. Literally, I bet we've done 60 studies for people in the last 18 months exploring build to rent.
When you go to build to rent and you build a new house, first of all, when they're buying REOs and they kept them, they were all scattered. Right. And now you're building them, you have a choice, so do they have a preference of the choice?
I mean, think of it like a luxury apartment complex. Is it idiotic to be building luxury apartment complexes? No. Every neighborhood could probably use a brand new rental neighborhood where all the homes are next to each other with some amenities. And I've learned some pretty interesting things from the consumer side too. When a consumer moves into your neighborhood and is the renter, you kind of look at them like, that's the renter, they're transient, they don't feel as welcome. Seriously, when they move into some of these neighborhoods in Texas where everybody else is a renter, they've never felt as at home. They have block parties, the whole thing, there's none of that kind of taint. And these are professional landlords that take care of them. So there is a market for this. I actually think 10 years from now we may be talking about it getting overbuilt though, just like luxury apartments get overbuilt from time to time.
Is the builder the end owner, or is he building for a fee to somebody else?
So these are all, it's interesting, they're all brand new companies that are formed that don't know how to build houses. And so, so they've contracted with big companies. Lennar is building for 2 of them. Toll Brothers is building for BB Living. Taylor Morrison is building for Christopher Todd Communities. So they are hiring builders to build for them, and they look really good on Wall Street because they're booking it as a sale. Seriously, so there's a new buyer for a new home now. It's these companies that are taking 100 homes as soon as you're done with them. And they're going to their trades and saying, guess what? I'm going to lock you up for the whole year. I can keep your entire best crew busy all year long. They're getting better pricing from the trades because of it too.
When we're looking at new homes, are we talking, when you said amenities, so I guess I wanted to get, as you know, I've bought some lots and built some rentals, but those are just houses, you know. Are you talking about where these houses are, they have all the whistles and bells, like almost like the villages?
They don't have 50,000 golf carts like the villages. There's actually, we've actually done a report on this, so there's segmentation developing. So there's the 600 square foot home with a small yard that's pulling the person out of an apartment complex for the same rent who didn't want to be in an apartment but wanted a place for the barbecue and a dog. There's 7-unit long townhomes. There's some of them look like, frankly, look like vertical or horizontal apartment complexes. And then there are traditional homes, and each builder actually is specializing in one or the other. The ones that are actually doing luxury houses, they're very, very few and far between. There's a community, a company out of the Midwest who's built 90 of these already, 90 neighborhoods built to rent homes, all townhomes.
Okay. One more for you. And I don't mean to have anybody dominate, but there's just some subjects that's your expertise, so bear with me. In an interview, there was a couple of things that caught my attention. This was from Brookfield Residential, and he had bought over 100 malls.
Yeah.
To do what with?
So we all know what's happened to the mall industry. So General Growth filed bankruptcy, 165 malls. Brookfield Residential, which has a longer than usual investment horizon, picked them up. So, you know, it was a bidding process, so they probably paid more than the next guy. But they got 150 million square feet of retail surrounded by 300 million square feet of vacant land. And we coined this term suburban, where people wanting to live closer in. These malls are in awesome locations. They're redeveloping 12 of them already. Interestingly, they picked the 12 of the best, not 12 of the worst, to get started because they wanted a good footprint here. And you're going to see apartment complexes and other things popping up on the outer edges of these parking lots now that the other bidders weren't putting into their pro forma. I think it's going to be super smart. And the CEO of Brookfield is speaking at our conference in November on this topic.
Now, the other thing that he said was surprising to me. He expressed concern about the potential of having huge competitors come in the marketplace. Is he not a huge competitor? How big is big?
Yeah, I think that, we titled that one The Biggest Checkbook in Home Building.
Yes.
Yeah, but there's maybe about 15 companies that could compete with him.
But he's talking about Amazon, and I don't know how to...
That's a different issue. So they're a home builder too, and they've partnered with Amazon and others, and Amazon could build a home for no profit and be totally happy if they set you up to be doing all the purchases you ever do for the rest of your life in that house. And you laugh, but that is what they're trying to do with Alexa. So that is part of their strategy, and they want to know, well, the air filter needs to be replaced. You get an alert. We'll put you on a subscription for the air filter. There's a lot of things Amazon can do here to disrupt the industry, and he was watching it carefully because he's partnered with Lennar and Brookfield and others. Amazon has kind of learning the business.
Okay, and that was kind of leading me to you guys, is that how does somebody that's not big compete with people that have almost no end to the size they can grow? I mean, is that the nature of where like most business is going to go, is dealing with a few people? I guess that's my question.
So I think from our perspective, even though we're the largest in the world, we still only represent about 18% of transactions across the U.S., so there's still that remaining 82% that's available to the rest of the world. We actually did just recently sign a deal with Amazon, and it's exactly what you described, right? They're not trying to get into, the home transaction business. It's too sloppy a business, frankly, for them to be able to really scale. What they're trying to do is basically generate a referral platform with their 150 million Prime members and who knows how many, regular members, right? To say, hey, you're on our site. We have all this traffic. If you're interested in buying a house, we have a referral program. a Realty agent at one of our brands will represent you, right? And then there is basically a commission split, but it's not a commission split because they're not licensed. But basically there is X amount of dollars that are spent in buying home products and services from Amazon as a welcome to your house gift to those consumers, right? And you're exactly right. I mean, once they get Alexa plugged in and all that kind of stuff, they own you, right? They know everything about you. So I think it's interesting. So I mean, from the earlier panel, an interesting thought was, again, we have a hard money lender that helps us buy properties for our iBuyer program. But for the vast majority of real estate agents that are out there that would like to be able to offer some sort of an iBuyer program, but they have no means to be able to do it other than maybe financing them themselves, that would actually create a great, sort of synergistic relationship between you all and them to be able to say, look, if you have these opportunities, I'm willing to, to buy those properties. How much of them? Usually we're looking at somewhere in the neighborhood of only about 5 to 6% are investor grade, right? Or the seller is willing to take sort of the haircut that you all be looking for in order to have your margins, right? That other 95% of leads are meaningful to the real estate agent, right? And so they're thrilled to be able to have a relationship where if the seller does need to sell in some sort of time frame and is willing to take that convenience fee, right, the 7-Eleven factor, that you all step in. Otherwise, it generates much, much more deal flow for them. My final point on that is the Houston Association of Realtors just did a study on this a couple weeks ago, actually. And 86% of the consumers that they surveyed, the potential sellers, said that given the prominence of iBuyers in the marketplace now, they want to get an iBuyer price to at least know what their backstop is for when and how they might sell their house. So it's in huge demand.
Yeah, I think your point around the iBuyer, as you know, only a small percentage of iBuyers are given an offer, right? So the remaining 90% or 85% are lead gen opportunity for that real estate, and that's gold, right? And so that's why a lot of these folks are able to monetize that business across, because they may not make that much money on that one particular deal, but they're able to capture that lead, and that's what people are doing. And you see more real estate companies and small brokers trying to set up that iBuyer operation in key markets where they want to try to grab those sell-side opportunities. So,
how does the lending industry look at the fringe customer? So I mentioned financing for investors, and you're talking about that getting to be a bigger business, and that's a repetitive customer. So you can have somebody in this audience owns 50 houses with 50 loans, so that's one stop and a loan. And then the other thing I was thinking about reverse mortgages, are those niches that are not big enough to put all the effort in, or is it just solely the owner-occupant?
Well, I think there's obviously still businesses, reverse mortgages, that's still a decent-sized market. There has been obviously some scrutiny over the years around how that's been executed, kind of disclosure and so on. So that's something that, but with the aging population, I think that's going to be something that's going to be needed more and more. It's been through some rough waters in the past. In terms of investment, financing for investor, obviously you're all in that business and you know better than I. Most of my members that are independent mortgage banks, but in some cases, community banks that have high net worth clients will provide some of that funding. But it's still sort of outside of what their sweet spot is really. So.
Okay. Go ahead. Okay. Is there an underserved market right now in the people that can't get a yes answer right now that should be able to? What do they look like?
Well, if you look at and I'll just sort of look at the demographics. If you look at some of these countries that are dealing with, stagflation, the country is not growing, the housing market's not growing. It's because their population isn't growing. We are growing as a country,
right.
But that growth is primarily being driven by minority immigrants,
right?
And the lending, the savings pattern, the credit history, the patterns of saving is so different for this new population. There are a lot of people looking at new ways of calculating creditworthiness. So do you have to have a certain number of trade lines with certain number of activities, or can you capture it in a different way? At the end of the day, you want to make sure you want to lend to people safe and soundly, and that you're going to get that money back. But I think there are some new technologies and ways that people are looking at lending. Credit scoring models that are different. Frankly, there are a lot of these fintechs that are looking at different ways of lending, capturing creditworthiness. So I think I actually expect a lot of improvements in that regard. I mean, there's some crazy stuff that's out there around, looking at your Facebook and deciding your creditworthiness off of Facebook and stuff like that. But setting that aside, I think we are going to see some innovation coming out of that side of the business.
I just have to smile inside because there was a meeting, we had hundreds of people in the audience, and I hadn't borrowed money in quite some time, and so I was really kind of dumbfounded. I was looking at charts that had gone way askew from what I thought would ever happen. And so we actually interviewed a lender, and it was a very short interview. I said, okay, stated income loans. So where does the stated income number come from? And without batting an eye in front of hundreds of people, he says, oh, we just make it up. I was, okay.
Yeah, that was a sort of normal course of business, right?
Yeah, well, it must have been.
Unfortunately.
Well, she asked us to remove that from the...
Or hopefully that person's out of business now.
No.
No?
No, but she probably doesn't have that loan program available anymore. Okay. I follow charts, try to look at trends, and we have, now I'm talking about California, but I wouldn't mind, John, just give me maybe some feedback from a national point of view. But with a set of charts that we currently have, we have affordability at 30% in California. Normally, we don't stall until we get to 17. That's a big spread. We have very full employment. We've got inventory at reasonably low levels. We have great equity positions. We have almost no foreclosures in the marketplace. These charts usually are accompanied by price increases in double digits, extraordinary volume of sales. We usually have 4 years of enormous volume of sales. We haven't gone up in 10 or so. So I'm just curious why we haven't had the breakout in sales and price this cycle, or is it yet to come? And I'm missing it.
Well,
I guess I'm missing.
That was called a pregnant pause. The boomers are doing what they said they were going to do. They've said all along we intend to age in place. So, and I would say that's exacerbated by their knowledge of what happened in the downturn. In addition to which, if they still have mortgage debt left, it's probably at 3.5%. So why would you give that up? So, you've heard me comment on Cape Coral, Florida, which is where I live, and which you're now doing some work in. Yeah. The kids call that God's waiting room. And you can tell they're being raised by an economist. There's no feelings whatsoever, not a part of the transaction. But the story 15, 20 years ago is when the kids move out, the boomers are going to sell their suburban house and buy a condo downtown because they were raised in the 60s and 70s. They're going to party the night away. Well, the evidence from Cape Coral is if you want a good restaurant reservation, wait till about 7:30. Right? But the fact that they're not moving, and they're not, they've said they weren't going to move, and they're not. So if you adjust for population, the existing home supply on the market is at 30-year lows. Okay. So there's nothing to buy.
But
right?
Why don't you have soaring prices then? You're telling me that you have a shortage of supply. If that was matched with capable demand, we'd be off to the races.
No, we're not doing PowerPoints, but I have my favorite chart. I'll be happy to share it with you. We track the inflation-adjusted real house price year-over-year change, along with current new construction. Those two data points are very tightly correlated for 30 years until the end of the crisis. Now what has happened is that price piece, which price is signaling to builders to build,
right,
or people to supply their homes. It's not just builders, but it's people to supply their homes. There's a huge gap that has emerged between those two. The builders are steadily building, but it's never been the case that first-time home buyers bought a significant share of new construction. That was move-up buyers. The other part of that is the Gen Xers were the group that their homeownership rate fell 9 percentage points in the crisis. That's huge. They're the ones that really took the lesson that said, you know, if you held on to the house, you already own the land, which is in an urban area, probably the most expensive part of the house. Tear the roof off and put another floor on, or push a wall out and add a room. So they're doing the remodel stuff. They're also not listing that existing home price. So real house price has appreciated very strongly nationally.
Okay.
The average inflation-adjusted appreciation from World War II to today is about 0.75%. For 5 years, it was over 4% in real terms.
Okay. Sean?
I think one of the issues is that affordability, percentage that went so low in 2006. Like, that's been measured exactly the same way throughout this whole period, but lending has not been exactly the same throughout that whole period. So, when you can get a pay option ARM in 2005 to afford a house, right, affordability can go lower than it can go today.
Sure.
So, I think that there's also maybe 30% affordability, right, by the way they measure it, is maybe not very affordable.
It may be kind of the equivalent of 11 in
It may be the equivalent of 11 back in 2007.
and 17 in the others. I agree with that. Yeah. I don't disagree with that. That's what the market is reacting like, is that we're sort of done.
Yeah, so we have a lack of supply, but we really are probably pushing up against what people can really afford.
Okay.
I mean, that earlier they were talking about, the number of mortgages with greater than 43% debt to income ratios, and the number with, higher than 90% loan to values. I mean, we're seeing a lot of like 104, 103% loans. And, to me, and then together with that, I heard from a couple of you that, well, there's not a lot of risk in that, right? Because the underwriting's much better and all the rest. Well, if you go back and look at the foreclosures of 2008, some of those folks were fine on an underwriting. It wasn't an employment issue. It wasn't anything else. It was, I overpaid for this house and I want out. And, and I think from that standpoint, and I don't think they will, let me just preface that, if house prices were to fall 40%, all that paper you think is so great is absolute crap.
Okay, so let's talk about the next recession then, and the ramifications on our industry price-wise. So is there any consensus, like, would you say we're going to have a recession in the next 12 months? Let's just say yes, no, or maybe?
I'll say no.
No? Okay.
I don't know.
I think we're already starting to see early signs of it. It's definitely, obviously, not going to be anything like 2007, 2008. But in the next 12 months, sure, I'll say yes.
Okay.
You'll say yes?
Sure.
Yeah, I believe there has to be a small correction. I do.
Okay. Now, okay, Sean?
I think that we don't have a market economy. And I think with our current administration, we would throw anything at not having a recession.
Yeah, we built an index to predict recessions, and normally within the 2 years there's a 27% chance, and according to the data it's a 75 right now. So I'd say that's probably yes, but I agree with him. They'll throw the kitchen sink at it if it's coming.
Okay.
Yeah, well, we don't have the same numbers as John, but the risks are rising. And we're never able to predict exactly when they happen, but the 12 to 18 month time period is.
Okay.
Well,
so let's go through the process of, okay, we get a recession, and we're gonna prevent it from getting worse. So the first thing Fed does is lower interest rates by typically 4 to 5%. And
they don't have that.
we don't have that.
Oh, sure we do. We can go negative.
Well, there you go. I read that. You can go negative. It's in a report I read. It's not a big deal.
Must be true. It was written in a report, right? Yeah. Well, so if you look at sovereign debt around the globe, take the U.S. debt out of the picture, 50% of sovereign debt is paying negative yields.
Yeah.
That's $17 trillion, right? So
And-
You pay them to have your money.
Yeah. Now, at the beginning of tonight, I think I mentioned something to the effect, and I just lost my thought. Can you believe that? Well, I'll tell you what was funny. I sent most of the people on the panel an email because we were messing around with the idea of negative interest rates. I said, so, okay, hypothetically, you owe $1 trillion and you'd be able to get a 50-year loan at minus 2%. You would never have to make a payment. It would resolve itself in 50 years just by taking your interest credit. So I thought, that would be good. Okay, so if we have a recession and we don't have that weapon, and by the way, what I was going to say is those countries really are not at the end of their negative cycle, they're at the beginning of their negative cycle. Is that correct? Do you think that? Like Germany or whatever is going negative, is it going to get more negative?
Well, there's no question their economies have slowed.
Right.
In fact, the Germans were, depending on how you define it, were in recession for a little bit. They're heavily dependent on trade and on manufacturing, and both of those things have been slowing because of the trade debates that are underway. So if you want to see Germany shudder, all you have to do is use the words car tariffs, because that's Germany. So
Okay.
no question, around the globe, things slowing, which is part of the reason that rates are where they are.
Okay, so the Fed can only lower so far, then it starts injecting money?
Yeah, one of the things that Powell did say in an answer to a question was that it was put the damper on the idea of negative rates. So that is, I think, the evidence that the central banks around the world have seen is that it really hasn't helped growth. But yes, they would expand the balance sheet. They would offer whatever liquidity services they could in the industry, but then the rest would have to be done by the fiscal policy. Tax cuts probably would come through.
What they're controlling is the short end, basically. If you had negative rates that got into pretty negative territory, there's an IMF report I read, it was minus 3%. They were trying to figure out ramifications of that. So what would happen to our 10-year if something like that was to occur somewhere else? Would we have that invert to quite a low number? I'm just curious.
Well, for those institutions, global institutions who do not have regulatory requirements to hold sovereign debt from their nation, which we do, for example, our banks have to hold treasuries as part of their capitalization, or asset classes for liquidity and safety issues. So some of the institutions overseas hold those securities or that debt, even though it's going to generate a negative yield over the course of the life because of regulatory requirements. But if they are not burdened by that, part of the reason long rates in the U.S. are low is because capital flows to the U.S. because it is a positive return.
Yeah, that's my point. Even if it would be positive, even if it was less negative than where it was coming from.
That's where expanding the balance sheet, increasing the size of that balance sheet will come in to attempt to hold those rates up.
Okay. So we have a recession. Does it cascade into lots of foreclosures this time and therefore have a negative impact on prices?
No. The whole regulatory framework changed in 2009, right?
Yes.
The regulators pre-2009, required that banks get rid of bad assets as fast as possible at any price. And as soon as they changed that, the course of the foreclosure crisis changed. And I'm not good enough on the history of the previous ones, right? But we let the savings and loans fail, right? And they kind of said, oh, we learned a lesson there. We're not going to do that next time. So, I think we learn something each time. We'll make a new mistake next time, but it won't be that.
Well, go ahead.
So I'll agree with Sean, but I'll put a different twist on it. So I think if there's a recession and people stop paying their mortgages, the servicing companies are required to foreclose on them. So I think we're going to see the foreclosure process started. I think the lesson learned this cycle was SNL last cycle was there's going to be a huge amount of money raised to do non-performing loans, and you can sell the pool to non-performing loans. And now you have all these rental companies, they'd be like, give me 1,000 homes with somebody in them that I can restructure as a tenant, I'll take it. And the federal government, actually, we had conversations in '09 with Doug at Fannie and Freddie and FHA about FHA becoming the landlord in this situation, and they just couldn't do it. I think they're going to find a solution next time. And the other thing is, if they really do hit the market, and I've asked American Homes for Rent and Invitation Homes and all these guys this question, like, how soon are you guys going to start gobbling them up? And their answer is as soon as the yields make sense. So
Yeah.
as long, and so
So it's
I
like
don't
a
think
natural
the odds of
floor.
like a 40% price decline or even a 20% are pretty low in that, in my view. And I actually think those guys would see a lot of new money come in and compete with them.
I think the other thing that is out there is, given the shortage of supply relative to the level of demand, if the recession is mild, excuse me, say unemployment runs to 7.5%, you still have 92.5% of households working.
Right.
Interest rates come down because the Fed eases. The demand curve backs off because of unemployment. But for those that are still employed, that means price appreciation is slower or maybe zero. And interest rates are great. Pretty good time to buy a house, especially if there's a foreclosure that you're aware of.
From the lending side, you know, what I've witnessed is, I mean, an unbelievable effort to not foreclose on houses in the last bunch of years.
It was sort of drinking out of a fire hydrant, right? For these institutions, they'd never seen that kind of volume coming through of delinquent notes and obviously foreclosures. I mean, I remember I actually at one point had an asset management firm that operated out of all 50 states, and one of my clients was Bank of America. They had 1.2 million delinquent notes. And I thought, okay, this contract for me is going to last forever, right? But, you know, lo and behold, they started selling off their notes left and right. And literally over about a 6-month period, it went from 1.2 to like less than half that, right? And so I do think there's huge appetite to buy. And I'm not sure whether, you know, people will be able to buy, you know, 30 cents on the dollar or 40 cents on the dollar like they used to last time around. That certainly isn't going to happen. But you also have a situation, I think, right now. The average down payment of what Fannie made, what is it? Like, it's probably like 68 LTV. What is the LTV on your typical book of business right now?
Oh, gosh, I'll get a number then. Somebody from Fannie Mae.
You just make something up and no one will know, yeah.
Well, 84% of statistics are made up, so.
Yeah. I mean, but the down payment cushion is quite substantial, even for FHA right now. And so I just, you know, it would require a pretty big hit in terms of price depreciation for, I think, big kind of flow of foreclosures and all that to happen. You know, from a lending institution point of view, I mean, obviously, you know, a lot of the community banks that hold the notes, I mean, that they obviously would get hit. People that are selling into the market, a lot of the independent mortgage banks, unless they've done something wrong in terms of originating that loan, they probably don't have any repurchase risk related to it. So it just sort of depends on who you are. And my guess is that we will not see what we experienced in, you know, 08, 09, and 10.
I don't think we'll deal with anything like that quantity, but I was thinking that the consumer kind of has been taught, I'm going to get a hug and get a recast and a 2% mortgage, and they're going to put it on the back end, or they're going to forgive it, and I can stay here for 4 years without a payment. I mean, that's what they just experienced.
Yeah, well, they did experience that, but you also had about 5 million people who actually lost their home?
Yeah, that was the first round, and that's when they went, uh-oh, we better not do that.
Yeah, so I think the pain of those 5 million people are still kind of alive and well. Obviously, there are people who got the pass, you know, they got, you know, they didn't have to pay a mortgage for 3 years or whatever it was, you know, and you certainly had those situations, but I do think just the general perception in the market is people got hit pretty hard. You know, a lot of people literally lost their home and really lost their trajectory in their life, right? So, and people are just kind of recovering from all of that now, and I don't know if it will be viewed as this kind of positive experience that somehow they'll get saved through the process, so.
Yes, or when you lean forward, I think you're going to say something. Okay. It's like, oh, never mind. All right. The economic policies that have been in place for quite a while, have they benefited the asset holder versus the wage earner? And if so, what are some of the ramifications of that we're seeing?
You just answered your own question, Bruce.
Yeah, I did answer my own question. You're right. So we're seeing these things, and like almost it's on a daily basis. So I read something, and they just floated a net worth tax. That was a new one, up to 8% of your of your net worth if it's over $100 billion per year. Okay, I mean, but what used to seem like completely ridiculous is now like being considered, oh, that's kind of reasonable. And that's scary stuff, because now you've got a kind of a list of stuff, college debt forgiveness, free medical, and I just think, okay, is this going to ultimately change some policies that are going to be really expensive for the U.S. economy? I guess that's where I was going with that.
I mean, you look at the whole rent control thing, right, in the state, right? I mean, it's going to have a detrimental impact on the investment side and frankly, the property. But because of the pain people are feeling, they are willing to go down this path.
That's right.
And so there's no real good answer. There's got to be a really solution for the consumer and the renter when they're paying 40-50% of their income into rent. Then you have people making irrational decisions to support something that's going to, over the long haul, hurt the industry and frankly consumers. So I don't know. That's why you're having this kind of wild swing in political debates right now.
Right. Well, the reason what you just brought up was interesting, because when we got the rent control, I emailed, and I don't remember if it was you, but I said, I don't recall voting on that.
Yeah, you did.
Because I do recall voting on it last year, and it was no.
Yeah.
And we didn't get to vote on this one, and it was
Prop
yes.
10.
Okay, so I guess, and the reason I was like tongue-in-cheek going, okay, what else don't we have a right to say no to? Or if we say no, they can trump it. So Prop 13. Prop 13's coming up on the ballot, not for the House portion of it, but for everything over 4 units, right? Okay, so I actually thought there's a good chance to pass, not that I wanted to, but if it doesn't pass, is that something they can trump and say, well, we disagree, we're going to go there anyway? That's astonishing.
Well, if it passes together with rent control, now, right, your taxes are going up every year, but you're being capped on your rent, so it's going to be a margin squeeze,
But isn't that what they would like?
Oh yeah, clearly.
Yeah.
And but it's going to end up in less supply, less being built, and other issues. I don't know if Sanders has his proposal of a 25% tax on flips, which should be of interest to everybody in this room. So every flip would get taxed at 25%. I think you can.
It already is. An extra 25.
I think you can thank Adam Data Solutions out there, because they keep talking about how much money everybody's making on flips. And what they're doing is they're taking the purchase price and the sale price, and they're taking the gross number. Like, how many of you have achieved that? Like 0 expenses, right?
No cost of any kind.
But that's what all these folks believe. They think we're just, everybody who's flipping a property is making all this profit. We got to tax 25% of it.
Yeah.
I mean, talk about dangerous statistics. Everybody in this room needs to call Adam and tell him to knock it off.
I was on a radio show and they challenged me with that, and I said, well, it's just the most ridiculous formula. So here's what the real deal is. Anyway, okay, I got to ask this one question, because last time there was a big pile of residential debt that caused problems. Is there big corporate debt bonds that could tilt over and be downgraded, that could cause a liquidity problem? And I guess the secondary question, are there side bets against the outcome of those bonds that are enormous in size?
I mean, the WeWork thing, right, is really interesting. You look at the amount of money that, SoftBank, right, so you've got WeWork, Open Door, Compass Real Estate, right? Katera on the construction side. I mean, these are like $500 million or larger investments in each of these things. And I think as a thesis, it's a good thesis, right? Real estate is ripe for disruption, right? I think we're all hearing and talking a lot about that. But there's a lot of money just in those, like, and so if you take that and go out wider, right? Like, how these iBuyers are working, right, is they're raising a lot of capital. And are they doing it to make really great, investments? And could that go wrong? And could it go wrong in a big, bad way? And how broad or wide is that, right? I think there's a lot of risk there.
If you look at non-financial corporate debt, the share of it that is rated high yield or BBB is the highest it's ever been.
Okay.
And in the BBBs are some companies that have regulatory requirements that they can't hold securities lower rated than that.
Right.
So one of the potentials is if there is a shock in capital markets that downgrades those BBBs, there's a bunch of companies that would have to make an adjustment, and there's a question, given the liquidity discussion we were talking about earlier, whether that liquidity exists in the market for them to make that shift. It's one of the consequences of a long-term low interest rate environment that the low cost of credit keeps firms in business that would naturally have exited the business at a higher cost of credit. So that is a risk.
How comfortable, like in one of those movies, there was a discussion about the ratings and how they were not accurate. So they had these tranches of AAA rated garbage, and that's what these guys were betting against. So when you have corporate debt that's got a rating, is that rating system now been cleaned up to where we feel that that's really telling the truth, or is that a competitive business where if you don't give a rating, you don't get business? I'm just curious.
I think the problem there is we're always looking in the rearview mirror, right? So we're saying, geez, these loans we made last year were really good and they haven't gone bad, so we can loosen up a little bit. We can loosen up a little bit.
Yep.
We keep loosening up because we're looking in this rearview mirror and things are just, well, they made the payments last year, we can get a little looser. And and I think that is absolutely the issue until you reach a point where there is some sort of little thing and then suddenly there's no market for that debt and it becomes a big thing.
Are there bets against the outcome of other people's investments to a big extent?
Not to the degree that it was during the crisis.
Okay.
But there are still derivatives, significant numbers of derivatives out there. And the worry in the derivative space today is how many of those are tied to LIBOR, which they're trying to replace with SOFR, a different index. I'd see the Federal Home Loan Banks were just given some guidance to be moving off of LIBOR by the FHFA. So there's some risk in that space.
Okay.
And I think Glass-Steagall and the Commodity Futures Modernization Act had more to do with the last crisis than anything else. We didn't fix either of those.
All right, we are almost out of time, so I am going to repeat the question I had asked before. You can answer one or both of them if you want. Anything keeping you up at night, like a black swan event? And what's the one thing you're most excited about for 2020? Jim.
Okay, it's late, so I'm gonna give the same answer to both. The elections.
Okay.
It keeps me up at night, and I'm looking forward to it for 2020.
Okay.
So.
All right, fair enough.
I think what's keeping me up at night is if you've seen the Realty stock lately, it's unfortunately a bit lower than our profitability and our operating sort of expertise would show. So that definitely weighs on me a lot. But I also think that as some of this hype boils over in the marketplace, that sound operating sort of margins and discipline will prevail in the next year, and we're going to round a corner. So kind of like Jim said, it's sort of the same thing, just two edges of the sword.
Yeah, what keeps me up at night is actually kind of different than this. It's actually the erosion of the trades in this country. I can't imagine how far down we're going to go if this trend keeps going. And then, what gets me excited, although artificial intelligence is an oxymoron, it's really not intelligent, is actually how much more thinking we can do if we start relying more on machine learning.
Interesting.
Great. So, I mean, I am thinking 100% of the time about we, after being in just 5 states for 12 years, are right on the cusp of going national, and I'm working on that 24/7. And that's also what I'm looking forward to most, is getting through that and being done.
Well, what keeps me up at night is I've got 72 employees, so I've got a lot of payroll. So navigating through this, no, but seriously, navigating through all the changes in the world, the election and everything else is, it's actually something I'm excited about next year too, but it's what I don't know is what I worry about. And you asked one of the key questions. Nobody tracks the derivatives that are going on with all that crappy junk debt. So nobody knows the answer to your question, and that scares me.
Spicy foods eaten late, teenagers. I think the thing that bothers me the most is that all of us have grown up with an interest rate path that future rates are higher than today, which is an encouragement to put off consumption and save, which is one of the fundamentals of a capitalist system. And the perversion of that through very unorthodox monetary policy, really worries me because of that huge outstanding amount of debt globally. It's the largest it's ever been. That definitely keeps me up at night. What I'm optimistic about, and this is not to be obsequious, is what happens here, watching the videos of these children, which is they're all our future, and the investment that people here make in that, and I'm very optimistic about the future of the country.
Thank you very much. I guess I will end by saying that I've ended it this way like every year for the last 10 years. My biggest wish is that every politician would not be a Democrat for the next 4 years, or not be a Republican, but be an American. And that we would do what's best for America, not for whatever. Aaron, where are you, my friend? How about we give Aaron an ovation for putting this baby together? He does. Thank you all. Drive safe. We'll see you next year. Okay. That was great.